Good morning, guys, and welcome to the CAM Financial Stock Market Update to begin the new year, 2017. We finished the year strong. The markets, definitely with the big rally after the Trump election, were a major benefit to everybody's trading accounts, I'm sure, I would hope. But, you know, all around, the markets did pretty well. You know, there was definitely some down spots. We'll take a look at a different system that a lot of people may have heard of. It's one of my favorites. It's something I like to understand, and you know, the backstory of it. And this year I'm going to actually build a couple different portfolios because I've heard of this system run a couple of different ways, and I just want to, you know, take a look at them for this year and see, you know, which one does the best, and I may go back if I can find adequate data and look and see how it performed over 2016 as well, just so that we have that information, and you know, maybe I can keep back testing it further and further back so we can see which way it works out the best. But before we go into this new kind of idea or understanding, let's take a quick look at the last trading day of the year. Pretty much red. A little bit of green over in the healthcare sector. The financials again were fairly green. A lot of red in tech, services, consumer goods, industrial goods, utilities, basic materials. You know, even healthcare's got a lot of red. Looks there's just, you know, a few little sections there of the healthcare area that did well. The generic drug manufacturers. Yeah, pretty much just drug manufacturing was the highlights. The major drug manufacturers were pretty much flat to down just a little bit. So, like I said, most of our green we're going to find over the money center banks again. The real estate investment trust for retail. You know, everybody's still looking for yield, guys, right? So even with healthcare REITs were up, financial REITs were up, or the industrial REITs were up. I mean, and investment banks were up. So, you know, a lot of search for yield still going on out there. People not necessarily ready to give up on the price appreciation that they get in stocks with the yield, versus just taking some of these bonds that, even though they are starting to offer slightly lower rates, are still you know, very low based on historic rates. So, you know, I understand why people aren't ready to jump yet with the yields where they are. So that should give us some insight into what 2017 is going to be like. I continue to think stocks are going to outperform the bond market for sure. I don't think you're going to see a lot of money rotating into the bond market out of stocks to buy, you know, these bonds that are slowly starting to pay a little bit better yield. Really, the only thing you might see is maybe the sale of a lot of bonds that people are already holding to try to move up a half a point to up, you know, to 1% or something, you know, depending upon where they've locked in these bonds at. So let's take a look then at so the three systems that I run. The first one, the oldest one, and again, this one's been around since October 2010. That was when I started running through this system and utilizing it for for stock trading, stock investing, really, because most of these I'm not selling until. So this system buys a stock. It will hold the stock until we get a 10% gain. At that time, I'll sell the initial investment and leave the profits in place and let them continue to grow, shrink, whatever they may do. Or when a company is purchased, bought out, obviously then it liquidates the position, and we put that money back on the side to prepare for whatever our next purchase is going to be. So this stock is now up to a total of, it's got 42 different positions, 4 of which have been liquidated through sales. Actually 3 have been liquidated through sales. The 4th is one that I have purchased twice, so I moved it back into the other section on my website so that I could follow it better. But this system ended up the year up 19.26%, versus the S&P up 9.55%, the Dow up 13.41%, and the NASDAQ up 7.5%. So the system outperformed the Dow by almost 6%, and was basically double the S&P and better than double the NASDAQ. I'm pretty happy with that. I haven't really looked through to see where we didn't do so well in that system. I know one stock that did real well in the system is Icon Enterprises. If you remember, we got into that back in August of this year, and back in November during actually it was in December, it was early December, it hit our price that we were looking to get to. So we got out of the initial investment and are letting a couple shares just continue to sit there and throw off the nice dividend that it pays. So let's take a look then. Let's go up a little further, see if there's any other ones that have not performed so well. PDLI, which is a biopharmaceutical, not so much. It's been down big time. DSW, I think it's actually not down much for the year, but we're still down quite a bit in that position. And then the last one I know that we've struggled with this year is Safe Bulkers. It's one that's we've been messing around with for a while. We've been in this for quite some time. Actually for the year it ended up almost up 50%, but again over the long haul since we've invested, it's still considerably down. So that kind of gives a little flavor to that system and where it's at. But just a lot of the other stocks we're holding in there just continue to throw off their nice dividends and getting some price appreciation. I mean, Chevron is in there. It's up about 50% this year. AVA, which is a utility company, is up 16-17%. I don't want to go through all of them, but that gives you an idea. I mean, that, like I said, that system's performed quite well. So now to the one that's kind of my favorite, I guess, not because it performed the best, but because I like technical trading systems. I like having a specific plan that's going to happen a plan of action for every trade. If it goes your way, great. If it doesn't, that's okay too. You just know when to get out, you know when to move on. We've already talked about the markets as a whole. This system actually was up 21.79% in 2016. So we're hoping for a nice continuation of that into next year. The stocks that we still hold in there. This is the one where Agnico Eagle was part of our big gains for the year. Go back to the top. So stocks that this holds is Blue Cap Reinsurance Holdings, Thomson Reuters, General Electric, Adtran, Ormat Technologies. I can't remember the name of this bank. WVFC is the ticker though. Bank of America, MetLife, ConocoPhillips, and American Airlines. So that, like I said, that system's performed quite well. And then we'll jump to the last system that we just started this year. This was the first year we initiated the idea of purchasing stocks that appear undervalued versus their historical mean or their historical norms. So that system currently holds Unum Healthcare, Exelon, and Marriott Vacations Worldwide. It's sold out of Sunoco. We took a pretty good loss on that. Really, we were down 24% for that one position. And then it also had SeaWorld, where we had some very outsized gains that pretty much offset the Sunoco loss. So this system has been in place since right at the end of April. It finished up 13.79% versus over that same time period the S&P 106.5%, or up 6.5%. The Dow was up 9.21% over that span, and the NASDAQ up 8.97% over that time. So and it's also outperformed this year. So whenever we're outperforming, it's always exciting, positive. So now that we've gone through our systems, I want to go back and take a look. So there's a system that a lot of people have heard about, especially if you follow the stock market intensively or extensively, called the dogs of the Dow. Essentially what that is I've heard it a couple of different ways. So one is you buy the 10 Dow stocks that have the highest dividend yield percentage, or I've also heard that you buy the 10 Dow stocks that had the worst performance in the year prior. So looking, I found somebody has a website out there that kind of tracks this, and looking at their 10 Dow stocks. So based on yield last year, if you'd have just bought based on yield, the highest yielding stocks, you're going to have Verizon Wireless would have been in there, up 15.5% this year. Chevron would have been in there, up 30.8%. Caterpillar up 36.5%. IBM up 20.6%. ExxonMobil up 15.8%. Pfizer 0.6%. Merck up 11.5%. Procter & Gamble up 5.9%. Walmart up 12.8%. And Cisco up 11.3%. So that portfolio right there definitely would have outperformed the markets for sure this year. I mean, just looking at those, I'm not. So you got one that's flat, one that's up 6%, and then pretty much all the rest were either with the Dow or ahead of the Dow. So definitely would have outperformed. Plus, you've got some pretty nice yields. Verizon at the beginning of the year had a 4.89% dividend yield, and Cisco was the lowest with a 3.09% dividend yield. So there's definitely definitely very interesting. Some positives in there in just buying the 10 highest yielding Dow stocks. The other way I've heard it is you buy the 10 worst performers. So what I'm going to do this year is I'm going to build on Google Finance. I'm going to build a spreadsheet, and I'll put the links out there once I get everything built, where it tracks the 10 highest yield at the beginning of the year, and it tracks the 10 worst performers from 2016. So if we're looking at the 10 highest yields going into 2017, you would have Verizon, Pfizer, Chevron, all would be there again. Boeing would be a new one. Cisco would still be in there. Coca-Cola would be a new one. Then IBM, Exxon, Caterpillar, and Merck. And you would drop Procter & Gamble and Walmart and add Boeing and Coca-Cola. If we go by the 10 worst performers in 2016, the stock portfolio is going to look like Nike, Coca-Cola, Disney, Visa, Pfizer, Home Depot, General Electric, McDonald's, Intel, and Procter & Gamble. So either way, you're talking about big companies, historically strong companies that you really shouldn't have major fears that these companies are going to go out of business. I mean, you take your dividend yield and you let your profits just continue to run. I mean, I definitely like these systems as a very is a more conservative way to play the stock market and really participate in some good gains. Like I said, and with Nike being down the way it is, hey, that might make sense to add to the portfolio. So that's it. We're gonna start the new year like this. Feel free, send me an email, leave a comment. I'm always interested in hearing other people's ideas and helping to answer some questions that people may have. I'd love to do that on the video here or through my Twitter feed, whichever, Facebook feed, however. So that's it for today. You can send me an email, chrism@campfinancial.net. And otherwise, we will see you on Wednesday. Take care.